Good evening, everyone. I think we'll now get underway. It's a great pleasure to extend a warm welcome to all of you to this seminar in this historic setting. The topic is Brexit, Banking and Financial Services. The event was organised with great efficiency by Fred Hobson of Brickcourt Chambers, to whom we owe our thanks. As we prepare for Brexit in about March 2019, it is becoming increasingly clear that Brexit is raising some challenging issues of national importance. One of the most important of those issues, and perhaps the most important, is how Brexit will impact on our banking and financial services, whose contribution to the success of the UK as a whole cannot be underestimated. There are really two overarching questions. The first is, what is the degree of risk to our banking and financial industries posed by leaving the European Union, and in particular the risk to London's preeminent position in the financial markets in the European time zone? Second, whatever answer you come to on the first question, how can we best mitigate that risk so as to come out in the best possible position in 2.5 years? The form of the seminar is that each speaker will speak for only a few minutes with a cap of 5 minutes. And we then want to make this a discussion about the issues with your full participation. Of course, anyone can ask a question, but we would welcome just as much contributions from the floor about the matters which have been covered by our speakers. To guide us through these questions, we have 5 very distinguished panelists. I will introduce them in the order in which they are going to speak. First off is, on my far left, Andrew Henshaw QC of Brickcourt Chambers, and he's going to remind us of the existing regime for passporting rights and third country rights under MiFID. Andrew is a silk at Brickcourt Chambers, whose practice includes banking, financial services, commercial, European and public law. He's litigated across all those areas. He's appeared in the UK in cases before the Court of Justice of the EU about market abuse and the UK's challenge to short-selling regulations, and he was formerly a partner in Linklaters. Second, we have the great benefit of hearing from someone who is not now a practicing lawyer. That is Caroline Binham, who's sitting on my immediate right. She's going to address the risk to London's preeminence if we leave the EU. Caroline is an award-winning journalist who covers the gamut of financial regulation for the Financial Times, from benchmark rigging scandals to Brexit to Basel. She was previously the FT's legal correspondent with a brief that covered white-collar crime, the legal market and government policy. Prior to joining the FT 5 years ago, Caroline covered financial regulation during the crisis for Bloomberg News. Third, we have Damian Bisseker, who is going to give us an industry perspective on these issues. Damian is a managing director of Credit Suisse in the General Counsel Division based in London. He is head of litigation for Europe, the Middle East and Africa, and has responsibility for all litigation, contentious regulatory and complex investigatory work in the region. Damian joined Credit Suisse in September 2004 from the law firm Allen & Overy, where he specialised in banking litigation and contentious regulatory work. Fourth, we have Jasbir Dillon QC of Brickcourt Chambers, who is sitting next to Caroline, who will be talking about the likely role of English law in international banking and financial transactions after we have left the EU, and which other jurisdictions will be trying to take business, legal business, away from London. Jasbir is a law graduate of Oxford and Harvard universities, and he has a specialisation in banking and finance litigation. He's been involved in many leading English banking cases, including the litigation arising from the collapse of Baring Brothers, the bank charges litigation, and Equitable Life, and more recently cases arising out of the 2008 financial crisis involving the leading case on the closeout mechanism contained in the 1992 ISDA Master Agreement, which we in fact did together, Jasper. And then finally, we're very pleased to have Simon Firth, who is going to talk about how all this affects the world of derivatives. Simon is, of course, the world's leading authority on the law of derivatives. He's a partner at Linklaters. He's the author of Firth on Derivatives Law and Practice. Since 2008, he's been the principal legal advisor to the English administrators of Lehman companies on their derivatives, repo and stock lending positions. This has led to Simon acting in the leading cases dealing with the ISDA Master Agreement and interpretation of close-out provisions. So those are our speakers, and without more, I will ask Andrew Henshaw to start us off.
Thank you. I can't remember who said today that Brexit seems tame compared to the events of last night, but we think that Brexit is still sufficiently wild to be worth spending an hour or so on this evening. I'd like to help set the scene by summarising where we currently stand on the right to provide financial services in the EU via passporting, and in particular where we'll be in what we might call the default Brexit situation. And by that I mean the position if we neither join the EEA nor manage to negotiate a deal giving full access to the internal market. There are 9 internal market directives giving passporting rights in relation to investment business, banking, insurance and reinsurance, insurance mediation, mortgage intermediation, alternative fund management, UCITS, electronic money and payment services. Where do we stand under some of these in the default Brexit situation? The answer, as you might predict, is rather a patchwork, but I'll just give 3 examples. First of all, for investment business, it will depend who the client is. MiFIR Article 46 allows third country firms, which is what our firms will be in this situation, to provide services for professional clients in the EU if the Commission has made an equivalence decision about our legal and supervisory arrangements. Now, logically, our arrangement should be found to be equivalent so long as we don't change them too much, because, of course, they're currently identical to the EU regime. But what about the practicalities? An equivalence decision has to be made using the committee procedure of so-called examination under Article 5 of Regulation 182 of 2011. And there are a number of factors, a large number of factors that have to be considered. And in effect, this gives the member states represented on the committee a power of veto, or at least delay, subject to an appeal process. And as a result, there is plenty of scope for politicking and procrastination. Cross-border investment business with retail clients is probably less extensive than the professional business, but here EU countries will be able to require third country firms to establish a branch, that's under MiFID II, and to satisfy them about matters like anti-money laundering, cooperation and tax arrangements. The second example is that for banking business, the CRD directive, Article 47, provides that the EU may make agreements with third countries to give EU branches of their credit institutions identical treatment. But there's no procedure and there's nothing resembling a right. And this is probably the most glaring gap in the third country regime. And then thirdly, insurance and reinsurance bifurcate in a way that's a little bit like investment business, but on a different criterion. For reinsurance, a declaration of equivalence will be potentially available under Solvency II. Equivalence declarations have previously been given in relation to Bermuda, Japan and Switzerland. But there's no equivalent for direct insurance nor for insurance mediation. the problem for the financial institution in all of these cases is that even if we do get either A, deal, or B, equivalence declarations, that seems unlikely to emerge until at the earliest, close to the date we are due to exit the EU. So in the meantime, they have to plan for the worst, and at some stage during the 2-year Article 50 period, take irrevocable decisions, given the lead times involved in things like relocation and getting authorizations inside the EU. And that leads on to 3 short points on which I invite views and comments. It would be very useful to get people's experiences and opinions on these. The first is, where there is an equivalence regime built into the EU legislation, is there any reason why the UK government shouldn't be working on that now, during the 2-year period, rather than it all having to wait until afterwards? The second point is, what is the scope for workarounds? In these relatively lean times for financial institutions, they're unlikely to want to make expensive relocations if there are less expensive alternatives. And those sorts of alternatives could include a legal alternative, such as an insurer using a pass-through vehicle which reinsures all its risk back to a UK company, or maybe as a parallel, a fund manager in the EU delegating work to a sub-manager in the UK. There may also be practical workarounds. Not all EU regulators, for example, require individuals to actually physically relocate in order to get authorization. I think that's true, for example, of Luxembourg and Ireland. And of course, there may be commercial solutions which may even involve deciding that certain EU business is no longer worthwhile to pursue. The last thing I'd just like to throw into the mix is this. To what extent do you think EU financial institutions will themselves press the EU to agree a reciprocal deal? And just to give one example, the letter which the FCA published to the Treasury Select Committee in August indicated that there were more inbound passports for EU firms than outbound for UK firms under the directives on insurance mediation, UCITS and credit institutions. And of course, the European capital markets are heavily reliant on capital raising in London. So I invite views on your experience on any of those points. Thank you.
Thank you, Andrew, very much. Well, I think we'll start our discussion off with those 3 questions when we've heard from the other speakers. Let's move straight on to Caroline for a view from the non-lawyer.
Thanks, Mark, and thanks to Brickcourt for asking me to be part of the panel tonight. I've been asked to speak about the risks from Brexit to the city. I guess the silver lining to President Trump is that Brexit doesn't really seem that bad anymore. But back to the matters in hand, I think you can take your pick, really, from the headlines, be it the 71,000 city jobs that are now at risk to the £10 billion worth of tax revenues that may no longer flow to the Treasury. A lot depends, of course, on how hard a Brexit we're actually talking about. And, of course, none of us know that. We just know that Brexit means Brexit, whatever that means. If the Supreme Court upholds last week's High Court decision over the Article 50 process, we should know sooner than originally planned what the proposed negotiating position is. However, the mood in the city is increasingly sombre, at least as we read it at the FT. There's growing concern that Theresa May will sacrifice free trade in exchange for curbs on the free movement of people, no more budgetary contributions, and no more jurisdiction of the ECJ in order to satisfy Brexiter demands to take back control. In any case, financial firms can't hang around to find out. They're already planning, and planning for the worst. If they lose their right to passport, as Andrew was talking about, then they have to find other ways to service their customers and counterparties across the EU, or indeed retrench. If the former, that likely means setting up in another European or probably Eurozone country, and that takes time and money, Time-wise, we're probably talking about 2 years, and of course that's the exact time that once we trigger Article 50, the time period before our EU membership lapses and all the flowing benefits. So in terms of risks to jobs and GDP, the figures that I cited before are probably actually quite conservative. There's also then the contagion effect to think about, and as you all well know, when we talk about the city, we're talking about far more than just finance. A very useful ecosystem has flourished around finance, and we have accountancy, advisory, and of course a £26 billion legal market to think about. As an aside, I would say that threats to our independent judiciary from prominent Brexiters only heighten the risk to London as a key global legal centre. If financial services retrench, then think of all those shiny new buildings going up in the city that will be empty. Commercial property is another obvious loser, and that's why we saw runs on property funds in the days immediately following the referendum. Think about the 2008 crisis. What started in banks very quickly had a spillover effect to the real economy, and high street shops and homes across the country still, some of them remain shuttered to this day. London has enjoyed this self-perpetuating benefit of what economists call a concentration effect for the last 50 years. So we have resources, knowledge, trade and finance all in one place. Whilst it's true that perhaps only 20% of what the city does is truly of a cross-border nature with the EU, if we dilute that concentration, London loses out. Europe also stands to lose. There's the obvious way, like in a giant Jenga game, that if the UK element comes out, then the whole European project risks crashing down. But also at a more granular level, as Andrew alluded to, for European financial firms, and there are more than 8,000 of them that are in London, passporting is a two-way street. Then also think about all that sovereign debt emanating from European jurisdictions, currently underwritten by units of global investment banks that are in London and passport through Europe. What happens to that in 2019? If that concentration that I was talking about is diluted, it's not like it particularly accrues in any one other jurisdiction, although I'd be interested to what you say later, Jasbir, on this. I would have said that the one exception to this might be New York, but I think after Tuesday, all bets are off, and we probably need a whole new seminar to think about what that all means. Very briefly, what we know about Mr. Trump is that he's anti-regulation, but that he's talked tough against Wall Street in the campaign. He's generally isolationist, so probably very sceptical about international fora such as the FSB or Basel. So I would predict a growing balkanization of approaches to regulation across the world. And that, of course, gives a lot of opportunity for regulatory arbitrage. And I think a rowing back of the post-crisis consensus that had already built, and perhaps Brexit had already put a spanner in that particular works. So I think big picture, the risks to the city are obviously enormous. There are some, such as Barney Reynolds at Sherman & Sterling, for instance, who posit that it's an opportunity and that it's a chance for us to rid ourselves of cumbersome EU rules and make London like a Singapore of the West. It's a minority view right now, but I think for all our sakes, we can only hope that it's more than wishful thinking.
Thanks, Caroline, very much indeed. Well, after that rather sombre assessment, is there any better news from Damian, who's going to speak about this from an industry perspective?
I'm not sure there is, I'm afraid. But,
right.
Again, thank you very much for inviting me. I thought I'd try and give you a bit of colour from the in-house banking perspective. What I'm saying is more sort of general observations rather than issues that are specific to Credit Suisse or Credit Suisse's thinking. But I think that the way sort of we perceive it in-house is banks are in a very difficult situation. There is, as we've seen, a huge amount of uncertainty as to how regulation is going to play out, how countries' protectionist standards are going to be implemented, concerns over the time frame exacerbated by the recent Miller decision. But that is juxtaposed with real pressure on banks to get moving and start making decisions. Some of that comes from regulators. There's a lot of regulatory pressure to have plans in place and certainly prepare for the worst case scenario. But there's also no last mover advantage here. I think there's a real sense between banks that some banks are much further advanced than others in terms of setting up practices in other, I guess, more popular locations, sort of Ireland, Luxembourg being classic examples. So people don't want to be stuck at the back of the pack when there's a whole queue of people talking to regulators, hiring top talent, getting the nice offices, etc. So I think very soon, probably in the early part of the new year, we are going to see some momentum and some real decision-making. So in terms of what banks really should be doing at the moment, and I think different banks are at different stages of the thought process, but they really need to decide how significant is business with EEA counterparties. I mean, it's sort of public knowledge that at Credit Suisse, the figure's roughly about 18% of revenues coming from EEA-based clients. And that's actually quite a low-margin business. So you have banks, I mean, Credit Suisse is an example, which is sort of publicly focused much more on Switzerland. Asia-Pacific as the growth areas, much less so within Europe. So what a bank would need to do is look at each of those relevant jurisdictions and consider a whole plethora of different issues, tax issues, employment issues. What's the attitude of the regulators? How knowledgeable are they about risk models? How quickly can they approve capital models? What's their view of different types of models where capital is actually going to be flowing out of the jurisdiction? And then aside from looking at the jurisdictions, they have to look at a variety of different models, as Andrew's alluded to. They could sort of sit back and do nothing, which is quite a risky attitude. Certainly in my view, Caroline's referred to sort of Barney Reynolds' paper, which I think is a bit of an outlier at the moment. There's the concept of getting branch licenses. I think that's a relatively sort of untested concept. It tends to sort of focus on just specific EEA jurisdictions and specific types of business, so it may be suitable for sort of some smaller players. There's a possibility of setting up a sort of agency arranger mechanism whereby you have intermediation between an EEA established entity and an entity back in the UK, but that tends to only work for certain jurisdictions that permit sort of passive bookings, and France, Spain and Finland in particular, or I think what's probably more popular is this sort of riskless principal concept where transactions are entered into through the EEA firm and then back-to-back through the UK, but again, then you have sort of intercompany exposure levels to worry about, or you could just ditch the UK completely and just set up shop entirely in the EEA. So there's a whole mass of different options which banks are working through. And I think it all comes back to the initial point is, you know, how much time, effort, money do you actually want to put into this business, or do you want to sort of focus elsewhere? The other two quick points just to mention in terms of steps banks should be and are thinking about to protect their position is the issue of lobbying. I think there's a lot of lobbying going on together with industry bodies of the government. But that's quite hard for banks to do. Banks aren't particularly popular. We've also had a lot of scandals, very much focused on London, LIBOR, FX, PPI. So I think historically we're sort of banking finance sort of fifth or sixth in the pecking order in terms of industries. I think that's beginning to change now, and there is you may have seen there was an Oliver Wyman report fairly recently which gave some fairly stark indications of the potential repercussions of losing London's preeminence. And the flip side of the lobbying is actually there's a lot of lobbying going on by foreign jurisdictions coming in and meeting senior people from banks and trying to encourage them to move out of London and set up shop elsewhere. And that's quite that's kind of slightly at odds with some comments that some senior people in jurisdictions are making about their actual capacity to house large financial institutions. I think there's a comment by Governor of the Central Bank of Ireland to say that, you know, they thought they were reaching capacity nearly. So. And then my last point was really on documentation. You know, what can lawyers in-house be thinking about to protect the bank in the light of Brexit? And I think that the real answer there is it's just too early to tell. It's very difficult to sort of contract for eventualities which are far from clear. I think the focus is very much now on the infrastructure, rather than the drafting. I would say that I think there really will be, and Jasper will be far more knowledgeable than me about this, but I think there would be a real reluctance to move away from English law and English jurisdiction. There's a host of reasons why that works very effectively for banks and financial institutions. And moving away from that, you can't just change the governing law clause to French law, Spanish law. There'd have to be an enormous comparative law analysis process. And one minor point, I think, which we're focusing on is use of process agents. I think, assuming service regulation doesn't get reenacted, then we're certainly encouraging people to make sure there are process agents available. But so I hope that was helpful.
Thanks, Damian, very much. Your last point on documentation leads very neatly into Jasper QC's presentation. Jasper is going to tell us whether English law and exclusive jurisdiction clauses are going to be on the way.
Thanks very much, Mark. Everything that I say is obviously subject to the caveat of what I describe as the Forrest Gump point. That is that Brexit is as Brexit does. The expectation, I think that certainly I have, and it's very reassuring to hear that Damian seems to share it, is that market counterparties are unlikely to shift away from English law to another governing law for international financial agreements as a result of Brexit. Just taking English law first, the reasons for the popularity of English law are very well known, but in summary, the comparative certainty that it offers, stability, familiarity, something that shouldn't be underemphasized, and of course the commerciality of English law, which has been developed by the English courts over centuries. Now, none of those factors in favour of English law are likely to change as a result of Brexit. As well as the question as to whether or not any of the attractive features of English law are going to change as a result of Brexit, this question that we're concerned about also has a comparative element. One also needs to look out and see, well, is there another system of governing law that has some greater advantages than English law? And put shortly, I don't see any system of governing law that is a competitor for England that has any real possibility at the moment of overtaking the popularity of English law for market counterparties. Now, moving on to the question of jurisdiction clauses, the market counterparties seem to me, again, to be unlikely to shift away from selecting English jurisdiction in their agreements post-Brexit. We don't know at the moment what the regime will be that replaces the recast Brussels regulations, which regulates jurisdiction agreements and the enforcement of judgments across the EU. Now, of course, I acknowledge that there is no room for complacency because it's very well known there are a number of strong competitors for London's crown as the most popular centre for international dispute resolution. Having said that, the central expectation that I have is that market counterparties will continue to regard, post-Brexit, England as the forum of choice for major international financial contracts. And there are a number of reasons for that. Post-Brexit, the commercial court and the financial list are likely, almost inevitable, they will maintain the expertise that they have developed over a number of years in English commercial law and also financial instruments and transactions. The English court's adherence to the principle of freedom of contract and their independence and integrity and fidelity to the rule of law all are very powerful factors, seems to me, in favour of maintaining English jurisdiction clauses. One development that one might see post-Brexit, though, is a move towards exclusive jurisdiction clauses, English exclusive jurisdiction clauses, rather than non-exclusive clauses. And I say that for this reason, that if the United Kingdom ratifies the Hague Convention on Choice of Court Agreements post-Brexit, which I expect, that only applies to exclusive jurisdiction clauses. But in that event, the EU, which is already a party to the Hague Convention, will be obliged to recognise those English exclusive jurisdiction clauses, and perhaps most importantly, the EU member states pursuant to that convention will be obliged to enforce the judgments of the English court rendered pursuant to those clauses, perhaps subject to slightly different procedural requirements than you have under the existing regime. But that, I think, will lead to a tendency to exclusive jurisdiction clauses rather than non-exclusive. One potential interesting development that we might see post-Brexit is if there is no bilateral treaty between the EU and the UK that essentially reinstates the existing recast Brussels regulation, then there will be no difficulty for the English court to enforce exclusive jurisdiction clauses where you have defendants who've issued proceedings in another jurisdiction, including issued proceedings within the EU by way of anti-suit injunction. So that may well be something that we see. Finally, I should perhaps mention international arbitration. Of course, well known that London is, again, the leading international arbitration centre. And as far as I can see, there's nothing that will be adversely affected when the UK leaves the EU, because the New York Convention, which regulates the enforcement of arbitral awards, is entirely unconnected from EU law.
Thank you, Jasper, very much. And finally, we move on to Simon, who's going to look at these problems through the prism of derivative contracts.
Yes, I suppose one of the things which is on the minds of some people that I've talked to is the extent to which the Master Agreement will still be used in 10 years' time. I'm sure you know it's been an extremely successful agreement in the derivatives market, the financial markets generally. Is that going to change? Well, Jasper's already said that he thinks it's unlikely that English law is going to be displaced as a favoured governing law for commercial contracts. And I think that is absolutely true. And I think that is particularly the case in the context of derivatives for a number of reasons. I mean, one consideration is the fact that if we move away from English law, assuming that it doesn't all go to New York law, there isn't any particularly obvious jurisdiction within the EU which would be used as a preferred jurisdiction. So the alternative is really that sort of people in different countries use their own local law to document derivatives transactions. I mean, that actually was tried a few years ago when there was an attempt to produce something called a European Master Agreement, which was designed to be used for to document transactions under a whole range of governing laws. I mean, it got nowhere. And one of the reasons for that is that one of the characteristics of the derivatives market is that you very often have a whole series of transactions entered into between chains of counterparties which are designed to hedge each other. And one of the things that banks don't want is to have a sort of an exposure on two transactions which are supposed to be matching each other. There is that potential for that exposure where you have New York law and English law being used for two transactions. But where you've got a number of different European jurisdictions with their very different sort of approaches to interpretation involved, there is much more of a chance, I think, of getting differential judgments on the different transactions. That's very unattractive from the perspective of the derivatives market. Another consideration is that one of the problems that the derivatives market has is there really isn't a lot of, hasn't until quite recently been a lot of predictability about sort of how judgments are going to go. There hasn't been a lot of case law, particularly on the is-the-master agreement. Now that has just started to change in England, and we've got some actually very helpful judgments out of the English courts. If you started to litigate in the rest of Europe, you'd be effectively starting from square one and litigating in courts where the judges have very little understanding, certainly in comparison to financialist judges in the UK, about the derivatives market. And without that understanding of the market, I mean, the chances of getting consistently good quality judgments, I think, are pretty low. So I'm quite optimistic about the continued popularity of the is-the-master agreement. I mean, there's a separate question as to what's going to happen to the location of the derivatives market, but in terms of the documentation which is used, I think it's going to continue to be based very much on the same documentation that we use today.
Thank you, Simon, very much. Well, how nice to end on a more upbeat, optimistic note. We're now going to throw the seminar open to the floor for discussion or questions. Don't be shy. No one's going to shoot you for asking a question that others don't like. Has anyone got any questions or contributions? Yes, thank you.
A very simple sounding question. Can any of the panelists see any positives from a Brexit?
Well, I mean, I see a positive in the sense that, we will hopefully be able to jettison a whole, or at least rewrite a whole bunch of European legislation. And one of the great frustrations of practicing in an increasing amount of European law is to try and advise clients clearly what the position is, where you're dealing with, frankly, European legislation which is not drafted to a particularly professional standard. I look forward to the day actually when we'll have, English Parliamentary Council actually redrafting some of this, and we'll get it a little bit clearer, I think.
I mean, the other obvious advantage, I think, certainly for those of us in this room, will be if you have to choose between a judgment of the European Court of Justice or the UK Supreme Court. I think most of us, or if not all of us, would choose the UK Supreme Court. So even if you have reinstated the existing European regime, but it now has to be interpreted by the UK Supreme Court, I think you're going to get a level of rigour and clarity of analysis that I'm afraid is lacking with the European Court, where you have judgments given in the way that they do, which are on occasion very obscure.
Do you hear grumbling, Caroline, about the quality and quantity of European regulation?
Yes, of course, all the time. And I think to answer the question, yes, there are opportunities, obviously, as Simon has alluded to rid ourselves of some of the more cumbersome regulations, as I mentioned. I think the problem is that looking for a net positive is difficult, because we've got to get through all the pain before we get to the bits where we're rewriting, and it's just whether we see a net positive, I think. And that's difficult for me to see right now.
Right.
I mean, another positive from a sort of infrastructure perspective is it does give the banks an opportunity, much like sort of the Big Bang did 30-odd years ago, to take a real look at itself and decide, okay, how does it want banking and financial services to operate vis-a-vis the EEA? I think historically banks tend to be very reactive and, see opportunities in the market and sort of build on them, and it's quite sort of iterative,
Yeah.
whereas I think this is a real sort of inward-looking moment for banks. So, that's no
A question at the very back. Yes.
Yes, the UK government, I believe the beginning of this week or end of last week, said that it will implement the GDPR data privacy regulation in spite of possible Brexit. So my question is generally, to what extent do we still have pure English law, or has pure English law ever existed?
My goodness.
Well, maybe I'll have a go at this. I mean, obviously, European legislation is incorporated within English law in a large number of fields, and wherever there is a reference to European law which Parliament considers we should keep, Parliament is free to keep those provisions. But I think, I mean, from my perspective, and often there will be sector-specific decisions about whether you are better off, as Caroline said, whether there's a net benefit for keeping certain European provisions, and there certainly are some net benefits, or whether there's a disadvantage that can be amended or just simply jettisoned. But in the general scheme of English contract law, which I think is probably the area of law that is of sort of most frequent relevance to all of us on a day-to-day basis, in the commercial field, and I'm not talking about the consumer field, which is obviously European law is deeply embedded within it, that's really relatively free of European law. So I think depending on sort of what you're most frequently engaged with, if it's English contract law, then I don't really think we've got anything to worry by jettisoning, or English commercial contract law. We don't really have anything to worry by losing European law, because it doesn't really, it's not incorporated, thankfully, within it.
Yeah. But if you take the recast Brussels regulation, now, could we enact legislation in the next 2 years to effect that that regulation shall continue to form part of English law after March 2019? Or is it non-adaptable? I mean, you may have to make some small amendments by, say, defining a member state in a different way. I mean, we could obviously enforce those rules in the UK, but we may lose the benefit of reciprocal enforcement in the remaining member states.
Well, I think the reciprocal enforcement is the key point. I mean, the common law conflicts of laws rules are pretty fine in terms of the English perspective about how you deal with jurisdiction. The key issue is, are we going to be able to enforce our judgments relatively speedily within the EU? And I think the answer is, one fallback is the Hague Convention, and that only applies to exclusive jurisdiction clauses. The other option, which I think is certainly lobby groups will be asking the UK government to seek, is a bilateral treaty between the UK and the EU, which is either Brussels recast or some other modified version.
There's one other rider to that, which is that it may be that if the Brussels regulation falls away because we leave the EU, the Brussels Convention of 1968 still applies, and that's a topic which Richard Akins addressed at the seminar a short time ago on jurisdiction. And there is quite a powerful argument that that convention will still apply, although no, that would have to be tested. But if it does apply, then in principle judgments will be enforceable, although there will be a number of disadvantages compared to the Brussels regulation. For example, we will be back with the things like the Italian torpedo, in other words, starting preemptive proceedings in other jurisdictions and the English courts then having to wait and see what they do about it.
Any more questions? Yes, you sir, with your hand up.
One, I guess, more perhaps observation than question, which is that, you know, we hear a lot about the sort of, you know, sunlit uplands of, you know, the post-bonfire of the regulatory rule books, but I think it is worth reflecting a little bit on some of the realities of that, and it comes back, I think, in part to this equivalence point. We've got this idea that we are ultimately assuming that we don't have a strong hand in Brexit negotiations, going to be takers rather than givers of regulation from the EU to the extent that we still wish to access the European markets. And I think once one looks across the array of directives that the first speaker mentioned, and you look to all of the rules that one has to keep in place in the UK to maintain equivalence, you end up, I think, with a very small array of areas where actually we have the freedom, post-Brexit to create not so much our bonfire, but perhaps a very small, cigarette-style level of conflagration. And that's going to potentially pick up areas such as remuneration, perhaps markets transparency under MiFID II. Those are areas where you don't need, equivalence because there's no relevant reciprocity kind of required. But I think it will be a very limited areas, unfortunately.
Yeah.
Well, I actually agree with that. I mean, there will not be a bonfire of regulation, and there are two reasons for that. I mean, the first is that the entity which has been the primary influencer of regulation in the EU has been the FCA or the FSA beforehand. If you look at the market abuse regulation, for example, it's taken straight out of the Financial Services and Markets Act and the Code of Market Conduct. And the other reason is that a lot of the more recent regulation, yes, it comes from Europe, but it's the result of an international initiative, as we've seen in the Dodd-Frank Act and elsewhere. So, the core content of regulation is going to be the same, but at the margin, as you say, I agree, there may be the ability to jettison certain things that we don't like. And I would like to think that we will be able to rewrite it in a way which is a bit more palatable.
Yeah, I would just jump in and I agree with you, Bob. I think, well, first of all, the Bank of England and the FCA have been very explicit already. There is going to be no bonfire. They've said exactly that. And also just the point that internationally the rules are set, certainly on the prudential side, at Basel, and they flow through to Europe. So whether we're in the EU or not is kind of a moot point. We'll still have to keep our prudential rules. Second of all, on the conduct side, as you say, the UK has always been a great influence and sort of brought the EU up to the level of the UK. I can't see that there's going to be any great rowing back on consumer protection. Bankers are still pretty unpopular, so conduct for the moment, even not looking to the EU, I think will still be much as it is at the moment. I think the one exception that I'm hearing is Solvency II. The Bank of England has always been a little bit sceptical about some of the points around Solvency II, and we've seen the Treasury Select Committee launch an inquiry as to whether there's elements of it that can be rowed back. So that would be the one area where potentially I would see things being changed.
Are you finding that the market is proceeding on the basis that Theresa May means what she says, that there will not be free immigration into the UK, and that Donald Tusk means what he says, which is that, well, if that's going to be your position, you won't have access to the single market?
Well, I think that's exactly what I was meaning when the mood is increasingly sombre, that whilst she is yet to pronounce upon what kind of access to the single market she wants, she has been quite explicit about curbs on the free movement of people. And to the EU, that's anathema. You can't have one pillar of the EU and not the others, as in movement of people, budgetary contributions in the ECJ. There's a quid pro quo.
Why did you say, Caroline, in your presentation that a bill before Parliament relating to Article 50 would require the government to disclose its negotiating position? I'm not they two entirely separate questions.
Well, certainly the process that's involved, my understanding is that the opposition want the ability to negotiate, to scrutinise the negotiating position. And hitherto, the government's position has been, no, we never show our hands before any kind of negotiation. Why would we want to do that? And you're right, they are two separate processes. But I think that the opposition and government generally, Parliament generally, wants the opportunity to, once they have that vote, for there to be a debate around what the position will be.
Right. Any more questions, contributions from the floor? Yes, over there. Thank you.
Hello, could I just ask if any serious thought's been given to the EEA option, which was discounted at the very beginning, but the UK is a separate signatory to the EEA treaty, and as I understand it, there is more flexibility on the freedom of movement of workers or movement of labour under the EEA treaty, so that it may be more negotiable, and it would allow, under an interim period, for the UK to stay in the single market.
I think there has actually, that initially was a favoured option, but I think certainly this week in front of the Select Committee, we had Andrew Bailey at the FCA saying that kind of arrangement he'd be quite uncomfortable with, and I think the Bank of England ditto, that they would be rule takers, not rule makers. You'd have to accept rules without having a say in how they're implemented, and I think the City has kind of increasingly got to that view as well, is certainly what we're hearing.
There was recently an article published by the President of the EFTA Court, which highlighted that possibility that you mentioned, and almost sort of offering an olive branch, and specifically highlighting the point you mentioned about freedom of movement relating specifically to workers. But I, like Caroline, haven't heard of any political warming to it over here. And the general mood from commentary seems to be that nobody is now expecting EEA membership. And I think in the Wyman report that Damian mentioned, I think they virtually discount it.
Can you just remind us, Andrew, of the three questions you posed at the end of your presentation?
Yes.
Some time ago
yes,
now.
of course. Well, they were whether people think that negotiations on equivalence can get going before we actually leave. The second one was how much scope people see for workarounds, which I think Damon has touched on. And the third one was to what extent people think that EU financial institutions may be pressing their governments to negotiate deals.
Yeah. Does anyone want to rise to the challenge of those questions? Yes, there's a hand at the back. Yes.
I'll have a go at the first one, if you like. I mean, in terms of prepping equivalence, I mean, there's no real prep particularly to be done from the UK standpoint, and it comes back to this point that ultimately we're a taker, not a giver for these purposes. Yeah, these equivalence notions typically depend upon an assessment made by the European Commission, which in turn is supported by one of the European supervisory authorities in actually going about that process. And so we are probably fully ready, actually, in all reasonable respects, because we're already subject to the wretched rules to which we'll have to be equivalent, whether you like them or not. But I think the concern, therefore, is less about the substance and more simply about political risk associated with the timing of the process or, in fact, the process itself being fixed.
Seems very unlikely to me that we're going to get an equivalence decision before we actually leave the EU. And that, if that is the case, that's an impossible situation for a bank to be in. It has to have something in place to manage that risk. So I'm quite sceptical about the equivalence route, personally.
I mean, I'm sceptical too, because I think European politicians have already said that they look as if they'll be rowing back on the granting of equivalence to the UK as a third country, purely because of politics.
Yeah, I think you're absolutely right. I mean, there's already a review of equivalence generally. We wrote this week that politicians have said it was never envisaged for the City of London. So we've got to take into account that why would European politicians ever give us that green card of equivalence before Article 50 is triggered? And the other point I would just say is that equivalence, yes, logically we should have it, and yes, it's just a technical decision, but it's not in this context, it's political. And if you think about just on the narrow point of of the equivalence debate between the US and the EU on clearinghouses, it took, well, it's still going on partially, but it's taken 4 years on a really narrow point to agree. So to get equivalence on everything that we want, I mean, good luck.
Well, the Canada deal is another illustration, I think.
Yeah, where one region can
Yes.
potentially scupper an entire thing. Yeah.
Can I just say, I think it's actually worse than that. So if you look at Germany, just take Germany as an example, and Damian, maybe you've got loans made into Germany. If you've got loans with commitments due under them in Germany, then from the point of Brexit, you've no longer got your license. And it's actually a criminal offence to lend the money under a pre-existing commitment into Germany without a license. Now, there is no equivalence notion for banking under the CRD anyway. So questions of whether there's going to be equivalence or not, there isn't. So you can see that actually it's a real genuine problem. But I see it very much as a problem not just for the UK, it's a problem for Europe as well, because it's going to hit ultimately real economy, refinancing needs for European clients. I will now shut up, I promise.
There was another question just the other side of the aisle a moment ago. Yes, it's there. Thank you.
With regards to jurisdictions that banks might seek to move some of their operations to within the EU, do we have a sense of a trend or any clarity as to which jurisdictions or cities might start to replace some of London's business?
Caroline, I think you're probably best placed on that.
So as I said, I don't see one particular jurisdiction being the net beneficiary of what we now have in London, apart from New York. But then, as I say, we've just had this massive seismic change in the United States, and with an increasingly isolationist president, I mean, I don't really know what that means and how that impacts yet on Brexit. In terms of European cities, they're the obvious ones that I think Damian had mentioned as well, that Dublin, Amsterdam, Madrid, Frankfurt, Paris. We're hearing, depending on what kind of financial institution you are, what kind of business you're thinking about migrating. But the big question, again, which I think Damian mentioned, is that, first of all, the regulatory authorities, but second of all, the central banks standing behind these financial firms also have to take a decision as to whether they're willing to have those financial firms in their jurisdiction.
Any more?
I'm sorry to bang on about this, but do any of the panellists think, in terms of pounds and pence to the city, that any aspect of Brexit could be a good thing for us?
This may have been a loaded question.
I mean, what I would say to that is that a lot of the debate is about what are the potential risks in relation to losing business in Europe. No one seems to have mentioned possibilities in relation to Asia. And we know that the Prime Minister has just come back from India and is meeting the senior Chinese politicians today. And the city is the Chinese renminbi offshore trading markets are burgeoning. We know that I think there's now a second issue of the so-called masala bonds, which are the rupee-denominated bonds. And so certainly as a non-banker, as a non-business person, there does seem to be opportunities for the city to expand, in particular in relation to Asia, in a way that perhaps while we are members of the EU, trade negotiation hands are somewhat tied. And the other thing that I would mention, speaking with my lawyer's hat on, is that one of the absolutely fundamental factors that has led to the strength of the city is not only the proximity of English law and English jurisdiction, but also a very large and diverse pool of English lawyers, as well as associated professionals, and all of the infrastructure that we have in the city to support the professionals, the lawyers, and the market counterparties. And if you look at potential competitors, either within Europe or outside of Europe, and I know, for example, that Mumbai has declared that they want to become a massive international finance centre. But if you don't have all of this infrastructure, if you don't have this pool of lawyers, if you don't have the courts, I think we have a massive advantage in that regard. And so I certainly do think there are opportunities. Whether those will be, whether those opportunities will eventuate, we'll have to see.
And I mean, I'd completely echo that. I mean, the other factor is obviously the slight collapse in sterling has made London a bit more cheaper, and historically people have been put off London because it's seen as a very expensive jurisdiction, and that's changed somewhat now. So that's obviously not great for us, but great for foreign investors.
Any more? Thank you.
There's always a tendency to look at the negative, the gloomy, the dull, and so on. It seems to me that one thing we haven't really spoken about is the weakness of the euro, the weakness of the euro economy, and the various pressures that will sit upon ever increasingly European politicians. And as somebody that's in and out of Austria and Germany quite frequently, I know that this is a factor that desperately troubles them, and they're very concerned about the losses to their economy consequent upon the losses as a result of Brexit. I just wonder what your views are in respect of that.
Thank you.
Yeah, I think I totally agree, and I think that was one of the points I was trying to make, that Europe is Europe also loses, and I think if you think about there's an Italian referendum next month, there are French elections next year, German elections, Dutch elections, all of those countries are facing populist parties as well. If we thought that we had issues with the EU, then that sentiment is echoed throughout Europe. So yeah, I think you're absolutely right. And London loses, but so does the rest of the EU.
If 2 or 3 major Italian banks went bust, and given that the Italian government is not allowed under EU law to bail them out, and given that an extraordinary percentage of bondholders in Italian banks are retail customers, so let's say the banks went bust and couldn't be rescued, and you then had a systemic effect across Europe, all these issues would look very different, wouldn't they?
Ask me.
Well, anyway.
Yeah.
I mean, I think that's a very valid point. I mean, one of the issues about Europe, certainly the Eurozone, is that the whole question of Greece has not yet been resolved. I mean, it's been sort of kicked into the long grass, but there is still a fundamental question there as to whether members of the Eurozone are prepared to accept an indefinite transfer of wealth and or the writing off of sovereign debt from the richer countries to the poorer countries, or alternatively, whether the Eurozone has to break up. And, that issue is going to have to be resolved sooner or later, and it may very well be resolved within the time frame of the Brexit negotiations.
Yes. Any more? Right, well, I think the lure of a glass of wine and a canapé has probably overridden curiosity. We're going to have some drinks and canapés. I think, Paul, is it at the back of this hall?
If you wouldn't mind giving us about 5 minutes, the staff will very kindly clear some space to bring on the much-needed refreshment. But please stay, please join us, and before going out into the dark gloom of November.
And can I, on your behalf, thank our 5 speakers. They provided some very interesting views this evening. And finally, thank you for having come to this event and made it such an interesting hour and a half of discussion. Thank you very much indeed.